an AI stock bubble, stalled U.S. regulation, and cautious institutional voices. Bitwise says these are real threats for Bitcoin, not just noise. Andrei Dragos, head of research for Bitwise in Europe, argues that many artificial intelligence-related stocks trade far above their fundamental reality. In his view, some valuations may be justified, but pure quantitative measures show that the group as a whole looks stretched. That is the definition of a bubble forming on the edge of the traditional market. Why does that matter for Bitcoin? Because a sharp unwind in an AI equity bubble could trigger a wider macro shock. When that happens, capital tends to run away from risk assets first. Crypto usually sits near the front of the exit line. If high-flying AI names crack, forced deleveraging and shrinking risk appetite could hit Bitcoin, even if on-chain metrics look solid. Dragos warns that this is less about technology and more about positioning. When investors crowd into one hot narrative, any disappointment can spill into everything else that trades on hope and growth. Bitcoin has earned a place in institutional portfolios, but it is still grouped with risk assets when fear returns. Bitwise Chief Investment Officer Matt Hugin sees another threat forming in Washington. A crypto market structure bill is sitting in the United States Senate. The proposal aims to define clearer rules and responsibilities for digital asset markets. On paper, that sounds constructive. In practice, timing and politics make the picture complex. Hugin notes that if the bill is not passed before the midterm elections in 2026, and if the current majority in the Senate shifts, the progress made on regulation could be rolled back or frozen. That would extend the period of uncertainty for exchanges, issuers, and investors. Markets dislike unclear rules almost as much as they dislike hostile ones. Without a stable framework, some institutions may stay on the sidelines or limit exposure. Others may choose offshore venues with weaker oversight, raising counterparty risk for everyone involved. For Bitcoin, that means slower adoption by mainstream capital and more noise around enforcement battles. A third warning comes from Ophelia Snyder, co-founder of 21 Shares. She believes that current market conditions make it hard for Bitcoin to repeat the kind of explosive performance seen at the start of 2025. In her view, a softer macro backdrop, investor fatigue after earlier rallies, and regulatory overhang all weigh on the chances of a strong start to 2026. Taken together, these perspectives paint a more cautious picture than the usual number-go-up narrative. An AI bubble could spark a risk-off wave. U.S. lawmakers might miss a window to lock in sensible rules. Key product issuers are tempering expectations for near-term upside. None of this guarantees a bear market, but it does argue for humility. For long-term investors, the message is simple. Understand the macro links between tech stocks and crypto, monitor the path of U.S. market structure legislation, and do not base your plan on a repeat of the last parabolic quarter. This has been BlockBrief. Stay informed, stay ahead.